Two men. Same age. Same college. Same first job. Same salary. On paper, identical. 27 years later. One is worth $1.14 million. The other? $802,000. A $338,000 gap. But here's the part that doesn't make sense. The one who ended up with less money spent decades believing he was the smarter investor. So, who was actually right? And more importantly, what would happen if this was your money? Let's go back. Michael and Kevin are 28. Fresh out of college. First real jobs. First real savings. $40,000 each. They're sitting in a coffee shop having the same conversation millions of people have. What do we do with this money? Michael doesn't hesitate. Real estate. He's been watching videos for months. He understands leverage, rental income, appreciation. He's done the math. It looks unstoppable. Kevin shakes his head. Too complicated. Too much work. He wants something simple. Stocks. Just invest. Wait. Let time do the heavy lifting. They argue. Neither backs down. They split the bill and walk out with completely different futures. Michael buys a rental property. Kevin buys an index fund. At first, Michael looks like a genius. He puts $40,000 down on a $200,000 property. That's leverage. He controls a large asset with a small amount of his own money. When the property value rises, his returns explode. His tenant pays the mortgage every month. It feels like free money. The tax benefits? Very real. Depreciation, interest deductions, delayed taxes. On the surface, Michael cracked the code. But here's what the coffee shop math didn't include. Every single year, property taxes, insurance, maintenance. Some years it's small. Other years, a $14,000 roof. Out of nowhere. Vacancy periods. No tenant. No income. But the mortgage? Still there. And then there's time. Calls. Repairs. Problems. 10, 15 hours a month. Eventually, Michael hires a property manager. Now he loses 8 to 12% of his rental income before he sees a dollar. And when he buys or sells, 6 to 10% gone instantly in fees. Add everything up honestly, and his real return settles somewhere around 4 to 7%. Still good, but not what he imagined. Now Kevin does something incredibly boring. He invests his $40,000 into an S&P 500 index fund. And every month, he adds $800. No strategy tweaks. No market timing. No excitement. Just consistency. The market averages around 10% annually before inflation. About 7% after. No tenants. No repairs. No phone calls at midnight. And complete liquidity. He can sell everything in seconds. But Kevin paid a different price. Not in money. In psychology. At one point, his portfolio drops 40%. $400,000 becomes $240,000. Fast. Every headline screams panic. People around him are selling everything. It feels like the system is collapsing. Kevin does nothing. No panic. No selling. Just holds. And within 2 years, full recovery. Then growth. That single decision, not to act, is what made the entire outcome possible. Fast forward 27 years. They meet again. Same coffee shop. Same table. Very different results. Michael's total wealth. $802,000. Kevin's portfolio. $1.14 million. Kevin wins. But look closer. Michael didn't fund everything himself. His tenant helped build that wealth every single month. Which leads to a better question. What if Michael had also invested $800 a month into stocks? This is where most people get it wrong. They think it's real estate or stocks. It's not. The smartest investors don't pick sides. They stack strategies. So what's right for you? For honest questions. Can you watch your investments drop 40% and do absolutely nothing? If yes, stocks. If not, real estate might protect you from yourself. Because you can't sell a house in a moment of panic. Do you want involvement? Real estate rewards effort. Stocks reward patience. Choose based on your personality. Does your local market even make sense? Take the property price. Divide it by annual rent. Below 15? Real estate might work. Above 20? Stocks often win. And finally, how long can you leave your money alone? Real estate locks you in. Stocks give you flexibility. But here's the truth. Neither Michael nor Kevin had the full answer. Step 1. Max out tax-advantaged accounts. 401k employer match. Roth IRA, automatic, tax efficient, powerful. Then, if real estate makes sense for you, add it on top, not instead of stocks. On top, because stocks build the foundation. Real estate accelerates it. Together, they beat either one alone. Every time. Michael and Kevin weren't competing. They were each using half of a complete strategy and arguing about which half was better. The smartest investor would have ordered another coffee and done both. Your move today is simple. Take 15 minutes. Run your numbers. Monthly investment. Years to retirement. Test it at 9%. Then compare it to real estate, with every real cost included. Because the answer isn't opinions. Not Michael's. Not Kevin's. Not even mine. It's in your numbers. Subscribe to Invest with Warren. Because in the next video, I'm showing you the one number that matters more than stocks, more than real estate, more than returns. Your savings rate. There's a specific income level where earning more money stops helping you completely if your savings rate doesn't increase. And once you see it, you'll never look at money the same way again. See you there. Rocket.